All right, everybody, we need to talk. I know, when I say year-end financial planning, you're probably thinking about boring spreadsheets and maybe a headache. But I need you to hold on, because what I'm about to cover is critical in this scenario. It's mid-December 2025. We have just a few weeks left in the year. Normally, this is a routine checkup. But in this scenario, 2025 is completely different. This year, this typically routine task is far more urgent. If we don't act right now, we could be leaving thousands of dollars on the table, or walking straight into tax landmines we didn't even know existed. Why is this year so urgent? We're facing a perfect storm of financial changes. 1. A massive, hypothetical new tax law, the OBBBA, has just gone into effect, and it's made figuring out deductions much more complex. 2. The stock market, after a huge run-up, is looking increasingly risky. 3. And healthcare costs are projected to surge in 2026. So, my goal here is to just break this down. No jargon. Just a simple, practical game plan for what you'd need to do before December 31st. We're going to cover 4 main areas: your taxes, your retirement, your investments, and your healthcare. Part 1, the OBBBA tax law. First, let's talk about taxes. This new OBBBA law changes everything. On the bright side, this law introduced a lot of new, very generous tax deductions. Remember, a deduction is great. It's money you get to subtract from your income before the government calculates your tax bill. For example, the OBBBA created a brand new senior tax deduction. If you're 65 or older, you get to deduct an extra $6,000 for singles or $12,000 for married couples who both qualify. That's on top of the standard deduction. And you can claim this new break whether or not you itemize. But, and this is the most important but of the entire year, almost all of these wonderful new deductions have an income limit. Think of it like a VIP coupon. The coupon is for $12,000 off, but the fine print says only for customers with an income under $150,000. If your income is $150,001, you fall off a tax cliff. You may lose the entire $12,000 deduction. This is why December 2025 is so critical. If you are anywhere near one of these income cliffs, we have to act now to get your on-paper income, your MAGI, down. How do you do that? The single easiest and best way: fund your pre-tax accounts. This is job number 1. If you have a 401k at work, log in tonight. Crank up your contribution to the absolute maximum for these last few paychecks of the year. Every dollar you put in that 401 or into your health savings account, HSA, disappears from your 2025 tax return. It helps you duck under that income limit, grab those valuable deductions, and save for retirement. Part 2, retirement. This brings us to part 2, your retirement accounts. This year, they aren't just for retirement, they are your most powerful tax control weapon. Besides maxing out your 401, there are 2 specific age groups that must pay attention. First, if you are between 60 and 63 years old, there is a brand new super catch-up contribution this year thanks to the Secure 2 Act. You can potentially stash an additional $11,250 in your 401 crew for a total allowable contribution of $34,750 in 2025. Not all employers are required to offer this, so check with your benefits department tomorrow. Second, if you turned 73 this year, born in 1952, this is the single biggest trap in the entire article, so please listen closely. When you turn 73, the law requires you to start taking money out. It's called a required minimum distribution, or RMD. If this is your very first RMD, the IRS gives you a choice. 1, you can take your 2025 RMD before December 31st, or they give you a grace period, and you can delay it until the 1st of April 2026. Almost everyone will think, great, I'll delay it. Why pay taxes sooner than I have to? Do not do this. This year, that is a massive trap. Think about it. If you delay, you will be forced to take 2 RMDs in 2026. Your 2025 RMD, which you delayed, and your 2026 RMD. What happens when you take 2 distributions in 1 year? Your income for 2026 explodes. That double hit could push you into a higher tax bracket and make you ineligible for some of those new OBBBA tax deductions. The advice is clear. Consider taking your first RMD now in 2025 to avoid that double hit next year. Part 3, investments. Okay, taxes and retirement are done. Let's talk about your investment portfolio. The stock market has had a fantastic run. It's up nearly 15% for the year so far. That feels great, but it means your portfolio is stock heavy and much riskier than you intended. If you started with a 60-40 stock bond mix, you may now have a 75-25 mix. The solution is rebalancing. It's the simple idea of sell high, buy low. In your tax-sheltered accounts like your IRA or 401ing, sell some of your winning stock funds and use that money to buy more of your losing fixed income investments. This locks in your gains and brings your risk level back to where you're comfortable. Next, tax loss harvesting. This sounds weird, but it's a brilliant move. Look at your taxable brokerage account. Do you have any investments that are dogs or clunkers? Sell them. That loss becomes a tool. You can use it to cancel out, offset the gains from your winners, which means you pay zero tax on those gains. If you have more losses than gains, you can even use up to $3,000 of those to offset your ordinary income. One last warning. Do not buy a mutual fund in December without checking one thing, the ex-dividend date. If you buy a fund right before it pays out its year-end capital gains, you will get hit with a tax bill for an entire year's worth of gains, even if you didn't receive them. Part 4, healthcare and charity. This is the final section, and it's all about hard deadlines. First, healthcare. Get ready. Healthcare costs are set to rise sharply in 2026. If you get insurance from your employer, they are passing costs on to you through higher premiums and deductibles. If you use Medicare, your costs are also expected to rise. But if you use an Affordable Care Act ACA marketplace plan, you are facing a premium cliff. A major subsidy is scheduled to expire at year end. This means some enrollees could see their premiums soar more than 100%. The lesson: do not auto-renew your health plan. Open enrollment is happening right now. You must log in, compare every single offering, and shop around. And one more thing, your FSA. If you have a flexible spending account at work, check your balance today. Most of these are use it or lose it. If you have money left, you must spend it by December 31st or you forfeit the money. Go buy new prescription eyeglasses, get dental work, or stock up. Just don't let that money disappear. Finally, charitable giving. The OBBBA law completely changed the strategy for giving. If you do not itemize your taxes, that's roughly 90% of taxpayers. Wait until January 2026 to donate. Why? For the first time, starting next year, the OBBBA law gives you a new deduction for charity. $1,000 for singles, $2,000 for couples, even if you don't itemize. If you do itemize your taxes, donate big in 2025. Why? Because starting in 2026, the new law limits the value of your itemized deductions. You get a bigger bang for your buck by donating before December 31st. Part 5, conclusion and disclaimer. So, as you can see, 2025 is not a normal year. This isn't, I'll get to it later. We are in a very narrow window of opportunity. The moves you make in the next 2 weeks will directly impact your tax bill, your retirement, and your healthcare costs. Here are your 3 most important takeaways. 1. Control your income. Log into your 401k HSA and see if you can get under those new OBBBA income limits. 2. Watch your dates. If you turn 73, you need to make a decision on your RMD now. And please, check your FSA balance and spend your FSA money before you lose it. 3. Don't auto-renew. Shop for your health insurance. Like your budget depends on it. Because this year, it truly does. Now, before we finish, I need to make something perfectly clear. Everything I have shared with you today is for informational and educational purposes only. This is not financial advice. I am not your financial advisor, and every single person's situation is unique. We are talking about a brand new, very complex tax law. The tax code is notoriously tricky. So, please, before you make any of these moves, I strongly urge you to speak with a qualified professional. Take this information to your CPA or your certified financial planner and ask them, what does this mean for me? I truly want to thank all of you for giving me your time and your attention today. I know this is dense, complicated stuff, especially during the busiest time of the year. My only goal today was to get these urgent items on your radar, to give you the right questions to ask, and to give you a clear action list to take to your advisor. Don't wait until New Year's Eve. Set aside an hour this weekend to get started. Thank you very much, and I wish you all a safe and financially secure holiday season.